part of what's coming is sort of wrapped up in some of these posts. This is David Bateman saying, a guy I know in Utah just reached out to ask me how he should go about a $100 million silver purchase. A few are starting to see what's happening. Silver will be unobtainium soon. Well, what comes after unobtainium, when nobody can get it, is unaffordium, because they keep on offering more. How are they going to stop 100 Hunt brothers in the U.S., 100 Hunt brothers in China, and another 100 Hunt brothers from the rest of the world? This time, they are all going to take physical delivery. Well, guess what? They can't. There's not enough, at least not at these prices. Maybe at $200 or $500 an ounce. No, it would be more than that. 300 Hunt brothers? No, this is going to be quadruple-digit silver.
The silver market is approaching a structural inflection point that looks nothing like previous cycles and far exceeds anything witnessed during the Hunt brothers era. What is developing now is not a speculative corner driven by a handful of wealthy actors, but a broad, systemic demand shock unfolding across industrial supply chains, institutional balance sheets, sovereign strategies, and retail accumulation globally. The defining feature of this moment is not enthusiasm, but necessity. Silver has quietly become indispensable to modern economic warfare, technological production, energy systems, and monetary hedging, while its above-ground stockpiles have been steadily depleted over decades. When demand begins to press simultaneously from all sides, the pricing mechanism is no longer governed by sentiment or historical averages, but by availability, and availability is rapidly tightening. Unlike prior squeezes that were fought and neutralized through paper leverage and regulatory intervention, this coming phase is fundamentally different in scale and composition. Hundreds of entities, rather than a few high-profile buyers, are now positioned to demand physical delivery at the same time. Industrial users cannot substitute away from silver without crippling production. Institutions seeking inflation protection cannot hedge supply chain exposure with paper claims alone. Retail participants, increasingly distrustful of synthetic exposure, are moving decisively toward physical ownership. In that environment, the market does not resolve through incremental price appreciation. It resolves through repricing, not a doubling, not a return to inflation-adjusted highs, but a disorderly upward reset that reflects years of suppressed valuation colliding with real-world scarcity. And this supply dynamic is only one layer of the broader thesis. Beyond the immediate shortage, there are deeper structural arguments around monetary debasement, collapsing stockpiles, gold-silver ratio normalization, and the role silver is poised to play in the next phase of global financial realignment. Stay with us, because what follows builds on decades of market observation and connects silver's price trajectory directly to the forces shaping 2026 and beyond.
Silver might be headed in 2026. So, Gold Silver HQ says breaking. Silver is now only 11.8 times away from its inflation-adjusted, M2 inflation-adjusted all-time high. So it's got almost 12 times to go. Now that's against the M2, where gold is and what happens with other assets. This is against the currency supply. So these are going to be dollar gains. Do other assets fall in 2026? I think that by the end of 2026, we should have a pretty good market correction because things are in hyperbubbles once again. Julius says silver is going to triple digits by 2026. I've been saying triple digits for years. 2026 sounds like a really good year for it. Could be 2027 though. We don't know. But 2026, that really does sound like by the end of the year, we're going to be there. Global markets react. China's silver exports halted. State-controlled flow, new license mandate. And all of the countries around the world are realizing that they don't have any more silver stockpiles. The U.S. used to have the world's largest silver stockpile. It was the strategic silver stockpile was the title of it. It's all gone. We sold it all off, and now everybody's realizing, oh my God, you can't conduct a regular war without silver. Oh my gosh, you can't conduct a monetary war without silver. Silver's a monetary metal. Oh my God. You can't conduct a technological war, the war that we are in right now. Technology. You can't conduct that without silver. It's more needed for that sector, the technological sector, than anything else. And Make Gold Great did a chart here, or distributed a chart. How do I buy silver? On Google hits a record high. And this is really interesting because this is the 2008 global financial crisis. This is when silver was peaking back in 2011. We went into a bear market. This is the pandemic, and look where we were in 2025. What will 2026 bring? Who knows, but it's going to be exciting. Smart Silver Stacker says gold to silver ratio continues to drop like a stone. Silver's time has come. Silver's time has come. This was on December 2nd. So it's pretty old, but silver started taking off like a rocket, and gold was still just sitting there. A few days later, Peter Spina on the December 16th published this chart, but this one is even shorter in time duration. This is the daily chart, and it was down to 66. Well, I like to look at things in a longer time perspective. So this is from December 19th of 2025. It was just below 65, 64.54 is the blue line. And we're going back to January 1st of 1970. And what you see here is that from 1985 until today, the line is sort of at the average where it was hanging out at. Silver has a lot of opportunity. In an insider's video I did recently, I called this the silver opportunity chart. The higher this is, the greater the opportunity. I was lucky enough to buy a good chunk in the pandemic plunge. When silver plunged, the opportunity went way up. So you have to go against your emotions when you're doing this. Everybody was panicking. Oh my gosh, silver's crashing. It's all the way down at $11. Time to sell. No, time to buy. So I've been lucky enough. I pay attention to this, and I have been lucky enough to buy on all of I buy more when it's up in this range. That's when I buy all silver, is when it's over 70. I would still be myself buying all silver. I've got a really good position. I don't need to buy any right now. But as it gets down in here, I would add gold to my position. And when it gets down to here, I'd be buying all gold. But the reason for this chart, the green line, I probably should have put this at 33, 35. But I just wanted to show you what everybody considered normal and average throughout the 70s bull market is that silver was about 33 to 135, 133rd or 135th of gold's price. And that was normal with enormous silver stockpiles available all over the world. Now, all of the silver is gone, and it's 1/64th of the price of gold. It makes no sense at all. In 1980, when they peaked, January of 1980, it dropped down to 14. And it is destined for this range again. It's going to go below 20. And there should be plenty of time. I believe it's going below 20. I believe silver is destined for triple digits. And the more that information that comes along, I'm starting to think maybe quadruple digits are possible. So this range, though, there should be plenty of time to catch that range. It isn't like you've only got one day where it hits the peak like it did back in 1980 when it hit 14 to 1. But I'm expecting it to actually blow past that. I think that you're going to see it down at 10 to 1 or something like that. That means that you can outperform gold by about 6.5 times right now. But gold is probably going to double, triple, quadruple. I don't know, but $8,000 an ounce is starting to sound a little bit low for gold. So I do expect it up at least at that range. And so if this is compounding the price of gold. If you've got a factor of 4.5 roughly from here to here. So 4.5, and if gold doubles, you've got 9 times gains against the dollar. And if other assets go down at the same time, like in the 2008 global financial crisis, from 2007 to 2011, real estate fell by half. But during that period of time, gold went all the way, gold tripled. And so if you had sold a home back then and bought gold with the proceeds and then sold gold when real estate bottomed and bought real estate with it, you would have got, for every home that you sold, you would have been able to buy 6 other homes, 6 homes just like it. So the gains can be tremendous.
As we move from silver's supply constraints into forward-looking projections, the focus naturally shifts toward timing, magnitude, and the macroeconomic backdrop in which this repricing unfolds. On one side, the outlook centers on silver's relationship to expanding currency supply, collapsing stockpiles, and the likelihood of a broad asset market correction that rechannels capital toward hard assets. On the other hand, attention turns to how the plumbing of the metals market itself may change, from futures market behavior and margin policy to ETF flows, sovereign intervention, and the diminishing role of leverage-based price discovery. Together, these perspectives frame 2026 not as an arbitrary date, but as a convergence point where monetary stress, industrial demand, and market structure collide.
So for 2026, we'd like to share 3 predictions with you all. First, we believe the Swiss will cut a deal with the US to support their soon-to-be flagging refining industry as pursuant to a way to alleviate tariffs. Second, we believe the LBMA will essentially become a subsidiary of the US COMEX, not in name, but in behavior. And the CME, we also believe, will raise margins to the point of making COMEX futures essentially a spot market, 100% effectively margining them. We believe ETFs and stablecoins flows will be the dominant investment vehicle for gold and silver in the US going forward. And we believe when that happens, you will not want to be a seller of your physical. Now, ask yourself, what price must silver and gold go to force such behavior like that? And that's where we stand. These markets the metals markets were all stronger overnight for the most part, very strong in silver and gold, and now they're backing off. Hard to think anything about this because it is holiday trading. However, it was easy to see that Shanghai would be bought because the US close was bought, and then Shanghai opened, popped, and then some profit taking came in. I think, I'm not sure, but the premium in Shanghai is markedly higher than London and the US again, which is a sign that there's no metal available from there to come here, and eventually the government will allocate more gold purchases, and that premium will shrink, dragging price higher, global price higher. Okay, so there's the front page. Let's get to the first 2 stories. Did Scott Bessent just tell us that Powell caved on 2% inflation? Secretary of Treasury Scott Bessent said the Fed could revisit its 2% inflation target once inflation is sustainably, whatever that means, back at 2%, arguing a target range may be more realistic than decimal point certainty. In a Bloomberg interview, he warned that changing the goal while inflation is still above target would signal tolerance for higher inflation. Correct. Bessent also linked fiscal discipline to structurally lower rates and criticized post-pandemic QE as lasting too long beyond the crisis window. You know, he made an interesting point about that. There are people, most of us that we know, that criticize QE and Bernanke and his helicopter money as being something that forced people to buy stocks because safe havens were hurt. And the government also steered people away from gold as a safe haven. And so anyone who had the money to buy stocks bought them. Well, most people don't have money to buy stocks now. And his point is going out too far on the yield curve, removed the safe haven, and that only helped people who had the means to benefit from it, to literally rotate, people with stock accounts. Now, I think that's really valid. And I want to put that in context of what he just did. Now, I'm not a fan of what's going on right now, and that is the Fed is now lending at 3 years out by buying bonds, and the Treasury is financing at 90 days out, give or take. And so they're doing a QE. Okay, so and I'm not defending them, but they're doing a QE. That's a QE. Okay, I don't care what you call it. If you're defining QE as how it benefits versus what it does, it's 6 and 1, half dozen the other. But what they're not doing is they're not doing QE at the 10-year or 20-year. And so I think the point is QE is necessary, but we don't want to go too far out. His criticism really is that we coddled the 10-year bond for too long and short-circuited behavioral market-generated metrics that would have kept us from being in too much of a bubble. In short, he basically just shit on Bernanke's QE concepts. And we're not so sure we disagree with him there. Anyway, how the silver rally might end. Now, this is a piece off of Real Investment Advice that we glommed off of Zero Hedge. And it's actually very good. It's a nice historical piece of what short-circuited the 2011 and 1980 silver rallies. And it predicts, it goes so far as to say it will end this way. And, we're big believers in history repeating itself. That's basically what we've been saying for the last year here with mercantilism and secular changes. But, we're not throwing water on it. You really, really should read this because it will happen the way he's saying. The question is how much of an effect will it have on the market? And we also put in a comment there that we say all the below that he's saying is true. There is one glaring difference between now and prior events cited. Margin rates will continue to drive out weaker leveraged longs as the sovereigns bin metals out of the public's hands. Futures are dying as they are tools of global trade. This is the point of why we say do not sell your physical.
Picking up from that structural outlook, the key takeaway from the metals market as we approach 2026 is that pricing power is shifting away from financial abstractions and back toward physical control. When margin requirements rise, futures contracts begin to resemble fully funded spot instruments, and ETFs absorb the bulk of speculative flows. The weakest hands are systematically removed. Leverage exits first. Synthetic exposure thins. What remains is physical metal held by participants who are structurally disincentivized to sell. This is not a bearish development for price stability. It is precisely the mechanism through which suppressed markets reset higher. At the same time, geographical premiums and persistent dislocations between regional markets are signaling something far more important than short-term volatility. When physical metal commands a higher price in one region than another, and arbitrage fails to normalize that spread, it reflects a breakdown in mobility, not a temporary imbalance. This is how scarcity announces itself before it becomes obvious in headline prices. Governments eventually intervene not to suppress price, but to secure supply, and history shows that once sovereign demand becomes explicit, price follows with force and speed. Monetary policy only reinforces this trajectory. Years of intervention along the yield curve have distorted capital allocation, inflated asset prices, and quietly eroded trust in fiat stability. As fiscal discipline weakens and central banks navigate the trade-off between inflation tolerance and financial repression, precious metals regain relevance not as speculative instruments, but as balance sheet insurance. Gold anchors the system. Silver, by virtue of its dual monetary and industrial role, amplifies the move. When gold rises in response to monetary stress, silver does not merely follow, it accelerates, compressing ratios that have become historically indefensible. What makes this cycle particularly compelling is that silver enters it from a position of extreme undervaluation relative to gold, depleted stockpiles, and rising non-discretionary demand. Previous peaks occurred when above-ground inventories were abundant, and substitution was possible. Today, neither condition exists. That alone argues for a higher terminal price than prior cycles, but when combined with a broader asset repricing and currency dilution, the upside becomes asymmetric. Silver does not need heroic assumptions to justify triple-digit prices. It requires only that market structure reflect reality. For investors, the implication is not about chasing momentum, but understanding where the pressure points lie. Markets rarely move smoothly when they are forced to reconcile years of imbalance. They move decisively, often violently, and usually faster than participants expect. Physical ownership, patience, and an appreciation for structural forces rather than daily price action are what separate outcomes in such environments. If you found this analysis valuable, make sure to like the video, subscribe for more deep dive market commentary, and share it with others who are tracking the long-term dynamics of precious metals. Thanks for watching, and we'll see you in the next one.